Hello everyone. I Dr. Gnanaprasuna, Assistant Professor, Department of Management Studies, Madanapalli Institute of Technology and Science. Today we would like to discuss about investment avenues. So before going to investment avenues, everyone have to understand about investment. What is investment? Why means so irrespective of MBA graduates or someone, everyone have to invest in their lifetime. So why they have to invest? The first question is why you need to invest. So without investment you may not gain any benefit in future end. So due to that reason you have to sacrifice something now. So without sacrificing today's objectives, requirements, wants, then you may not able to invest into future. So due to that reason everyone have to inculcate the habit of savings. So those savings further you need to convert into investment, right? So today we would like to discuss about introduction, definitions, as well as features, objectives, and different investment types, right? Then coming to introduction towards the investment. So investment involves making a sacrifice of the present with the hope of deriving future benefits. Definitely, whatever the sacrifices we would like to contribute now, that should be helpful in our future. That's what only we do something right now. Otherwise, we don't. Those sacrifices may not create any meaning for, right. So here, if you look at the picture, so in this picture itself, how the savings, if you contribute into investment, how it grows. So step by step. So likewise, if you represent seed for the sake of plantation, after that, if you thrown some water means, then it grow up day by day, and some other day it become as a big plant. So big tree, right? So like that, you can do the investment from the current sacrifices that you can enjoy the future benefits a lot. Then coming to definitions of investment. So as per according to Oxford Dictionary, investment is defined as the action or process of investment money for profit. So as well as according to Keynes, investment is defined as the addition of the value of the capital equipment which has resulted from the productive activity of the period. So here definitely, without current sacrifices, without current contributions, you may not generate any additional returns for your investment. So, there are many ways are available to contribute to your investment, but how to find out right appropriate investment alternative, then only it gives appropriate benefit in future. So your investment should create wealth for you as well as it should create returns, positive returns for you. Then only that will helpful for your career. So without investment, then you may not enjoy any returns from the savings. If you just keep the savings with you means it may not generate any additional value for that. So due to that reason, try to inculcate the habit of saving to be converted into investment. Then only those investments will generate in terms of capital appreciation as well as in terms of returns like dividends, interest, like that manner you can enjoy the returns from investment. So few of the example for investment avenues like equity shares, preference shares, debentures. So you can invest into gold as well as real estate, like many ways you can possible to invest. So that should be happen according to the investor's objective only we can decide. Then coming to features of investment involves, there are majorly four features are available. So first one is return, risk factor, safety of the funds, and liquidity for your investment. Yeah, coming to features of investment. So, in that, first and foremost one is return. So, everywhere without returns, you can't able to invest. No, for the simple sake, you may not contribute your current sacrifices to anyone or any manner. So, due to that reason, definitely whatever the investments you would like to contribute, from that you definitely expect some returns. The main objective behind every investment is getting return in the form of appreciation in the value of goods, dividend, interest, and many more ways. So here the return you can represent it, n return can be calculated by using of this formula: end period value minus beginning period value plus dividend divided by beginning period value into 100. So if you applied this formula, then you can possible to calculate what might be the returns from your investments. So for example, if I take an end period value is 110 and beginning period value is 100 and dividend might be 5 rupees, and if you applied these values into this formula, then you can generate a return from the particular investment is 15%, right? So without investments, so without investment, you could not expect the returns even. So definitely everyone have to sacrifice current requirements, objectives, and needs and wants for the sake of future returns only. Next one is risk factor. So risk is nothing but probability of actual return less than the expected return. The risk in investment is high in the following cases. So one is larger is the maturity period. If we are expecting high rate of return, low credit worthiness of the company, like these cases we can discuss now. So where there is no risk, anyone can tell no, there is everywhere there is a risk, right? So probably if you just went to road by taking bike or car something, so who knows who will met with accident? Who knows about that? Definitely, if knows means we keep on silent and we'll sit in home itself, right? So that's why everywhere there is a risk. At the same time, how best we utilize the electricity power, right? So many benefits without, you can assume without power in your in a day, no, it's not a possible factor nowadays. So once if you would like, you would like to touch the power, you want to touch? No way. So, high degree of risk I have to face. So, that's why every investment also poses certain risk. So, how much risk means? Again, it might be depends on the type of investment you chosen. So, accordingly, only the risk is involved in that investment, right? So, risk probably which minimizes the actual return less than the what we are expected, right? So in some of the cases we would like to discuss now, right? First one is larger is the maturity period. So in case the maturity period might be very larger, in case for example after 40 years or after 50 years, for the sake of 50 years span, I would like to contribute today as investment. Then after 50 years, I invested into, for example, I invested into equity share market. In that scenario, right, in a particular company equities, in future might be that company will grow upon into very peaks, might be there is a other phase of that company also been we can expect, that is if the company can wash out from the market means no, you can lose the entire investment, right? So when the maturity period can increases year by year means then your risk also might be increased only. So, for example, Satyam Computers, earlier days it created a wonder in stock market also in terms of share prices, everything it increases and it gives positive image in market. Everything went well in good manner. So one fine day, what happened, everyone knows. Now we you can't able to find the Satyam Computers, right? So like that, if anything went wrong, means our investment have to lose everything. A single rupee can't able to get back. So that's why you have to choose right, and time duration also plays very important for evaluating the risk factor. And second one is, if we are expecting high rate of return, so you are expecting high return means definitely you have to face the high risk also. Without facing risk factor, you may not probably get high returns. So due to that reason, risk always vested with the returns. Another one is low credit worthiness of the company. So, in case the company does not possess that much of worthiness, then credit worthiness, in that scenario also you may not probably get a high degree of returns, or whatever the expected returns probably may not possible to reach to that, because of it does not possess the good credit worthiness. So due to that reason, so then coming to another one, all the government securities have low risk and the private securities have high risk. Why I mentioned this one means, so everyone will assume that government securities will probably give very low risk, and assurance from the government means definitely will get back from the government. So due to that reason, it poses the very very lower risk. So low risk means automatically returns also you may not possible to expect very high manner. So moderate or low risk, low returns only can possible to receive from the government securities. So but private securities based on the high risk means you can enjoy high returns also. At the same time, risk is classified into three ways: high risk, moderate risk, and low risk. So high risk means that leads to high returns, moderate risk represents moderate returns. So and final one is low risk represents low returns only. That is well known fact for everyone. So without a risk taking, you can't able to achieve maximum returns. That is obviously how to accept. Then coming to another important one is safety. So whatever the investment you are contributing in, whatever the securities you choose, and as well as that security is providing high degree of returns, even though if your investment does not possess any safety precautions for your investment, then there is no use of doing of investment. So that's why probably try to select only investment venue which is protected under regulatory frameworks only. So otherwise you may not able to secure your investments probably. So due to that reason, who are not ready to take that much of risk in terms of investing into equity market, then they can simply go and invest into government securities. That is very safest one, as well as they can receive very less risk percentage, and they can receive more returns. So safety is first and foremost important for everyone's investment. Then another one is liquidity feature. So whatever the investments you are contributing, that should be possible to make into liquidity form. So how to convert into cash format whenever you have emergencies. So without at the time of emergency your investment can't able to convert into liquidity format, then it creates many problems that may not give any kind of satisfaction for the investor. So due to that reason, try to be a look over into your investment whether possess liquidity feature or not. So liquidity is is nothing but marketability of securities where we make investments. It represents the portion of investment could be converted into cash without much loss of time. It would help to the investors to meet emergencies. Then coming to major objectives for the investment. So here five are the major objectives represented. First one is every investor have to look over into their own objectives first of all. So investment objectives are okay, but as our requirements, as our needs and goals, every individual have to think about their objectives and accordingly have to choose the appropriate investment avenue. So here first and foremost what we think about our investment contribution, so from that contribution you expect maximum returns. That is first and foremost one every investor will expect from the investment. So why we have to expect maximum return? Because you already sacrificed many goals, many needs and wants. From that only you contributed your of money into investment for the sake of getting high degree of returns. So due to that reason, that is a very very quite common feature of expecting return from our investment. Next, another important objective is so minimization of risk. Definitely, you invest into different securities. How to minimize risk? You have to think over about that. So, without minimization of risk, you need to maximize your returns. For that sake, you have to diversify your investment. So you have to diversify your investment among different securities, means definitely which minimizes the risk factor, definitely you can maximize the your returns. So that is about minimization of risk. Another one is hedging against inflation. So on what criteria we expect returns, means at least which may not lesser than the inflation rate. So if inflation rate is 5%, your investment is your returns from the investment is 8 or 9%, then it is good. It's a hedging against the inflation. Or else in the case of reverse manner, your returns is 5% and inflation is 7 or 8%, means then it may not cope up to fulfill your obligations. So due to that reason, hedging against inflation have to identify probably. Otherwise you can't able to get better returns, you may not achieve your defined goals and objectives. Another important objective for the investment is liquidity. So liquidity represents already in previous I mentioned that. So liquidity represents how best you can possible to convert your investment into cash format without much more delays. So due to that reason, liquidity plays key role based on the objectives behind for the investor. So because everyone's objectives are may not quite common, everyone's goals are different, everyone's expectations are different. Who will based on the investor's risk taking process, it depends on the returns as well as how best they require the liquidity. Accordingly they can possible to define the liquidity feature is required in their investment avenue or not. After important one is safety. So whatever the investment you contributed, so for those funds, safety is there or not. So when we get safety for our investment, means whether those securities under the umbrella of a regulatory authority or not. So if it comes under regulatory authority, means definitely your funds protect the funds having the protection, right? Then coming to investment avenues. So this is first and important one why we have to discuss irrespective of specializations or might be branches. So any stream of people, any stream that might be literature one or illiterature one, anyone have to understand, have to know about investment avenues. So first one is equity shares. So equity shares represents in two ways you can possible to purchase equity shares. Okay, one is in terms of IPO, that is initial public offer on that company's issued stock, means then you can purchase directly. Or else who are failure to purchase from IPOs, then you can possible to purchase from stock markets. So when the company came into trading, that time you can purchase there itself. So then how do I purchase? So directly where I have to go and how to purchase the process, means so how by doing bank transactions. So without opening bank account, is it possible to do the bank transactions? Either deposits, withdrawals, loans and advances, whatever it might be. So without a proper bank account, is it possible? No way, right? So like that, here to invest into equity shares means definitely you have to open demat account. So this demat account allows you to purchase equities, you can sold your shares as well as you can hold down for longer periods, multiple transactions, multiple activities you can perform in stock exchanges by investing into equity shares. So equity shares are the real owner, equity shareholders are the real owners of a company. So here equity shareholders will receive the dividend from the company. It may not provides any guaranteed returns to the shareholders. So why means these are the real owners of the company. Due to that reason, they may not have any fixed percentage of returns. So due to that reason, when company earns more and more profit, they receive huge dividends from the company. If company may not earn probably profits in that during period, that year may not receive that much of returns in the form of dividends. So right, that is about equity shares. So there is a high risk involved in equity as well as high returns you can possible to earn through by investing into share market. Then second one is fixed income securities. So this fixed income securities means you can invest into your investment can possible to contribute in terms of debentures, bonds, like that. So which are the name itself presenting that is fixed income. So the income is fixed percentage already defined at the time of issue of those securities itself. So that means 10% debentures, 9% debentures, 15% debentures, so 10% bonds. Likewise, they provide the information at the time of beginning period itself. So due to that reason, those securities possess the fixed percentage of returns during the during this investment period. So here one thing you have to observe, so the income is very much fixed manner. So when the company earns more and more profits, may not delegate those profits to the bondholders or debenture holders. So only defined percentage of returns only they would like to provide for them. So due to that reason here risk is very minimum, as well as returns also been defined one, or else we can say minimum only. So lesser returns can enjoy by the bondholders comparatively equity shareholders. Then coming to another type of investment sources, that is mutual fund schemes. So why mutual fund schemes have to invest? I don't just think I don't have any knowledge to invest in terms of stock markets. So I don't know anything. I'm not ready to take any kind of risk by doing of investment without proper knowledge. So due to that reason, what I do it means I can approach the different category, I approach the mutual fund. So here, this mutual fund completely depends on the fund manager activities. How best the fund managers will provide the information, how best they can handle the funds appropriately by moving from equity to debt funds, as well as from debt to bonds. So likewise different ways how they best moving the securities. So accordingly the fund represents the returns. Here mutual fund represents pooling of investment from the different investors, and collectively that fund is invested for the specific purpose of maximizing the returns. Here for mutual funds there are two categories. One is open ended mutual funds, another one is closed ended mutual funds. So in case my investment objective is how to convert into liquidity format, in that scenario, I choose open ended mutual fund schemes because this scheme may not have any kind of time restriction to withdraw your investment. So, due to that reason, if my objective behind as liquidity feature means, then I go with the open ended scheme. So, in case I choose and I don't want to liquidity within a short span or 2 or 3 years span means, then I go with the closed ended schemes. So because of this closed-ended schemes represents 3 years is the lockup period for your investment. So in this 3 years, you may not able to get back of your investment at any cost. So due to that reason, based on the investors' objectives, how to choose the appropriate schemes under mutual funds. So growth schemes also there. Income oriented also there. So based on the categories of people, based on the objectives of investor, how to choose the appropriate mutual fund schemes for investment. Then another important one is deposits. Here you can deposit your investment into banks. So in that condition you can get the fixed percentage of returns during the time tenure. So when you deposit into 1 year time span, then you can get the some percentage of returns. So if you would like to invest for 10 years span, then you can generate certain returns. So likewise you can safely and securely would like to invest and defined manner without taking any risk. Such a category of investors can happily choose the deposits as the best option for their investment. Then coming to tax sheltered schemes. So the name itself presenting tax sheltered. So whoever the income tax payers, for them under 80C there was a deduction for tax exemption or tax minimization purpose. They can go with the tax sheltered schemes. So these schemes might be like public provident funds, retirement schemes oriented, education loans, health insurances. So these are comes under and under into tax sheltered schemes. So likewise, you can invest as well as you can gain the benefit of tax exemption or tax minimization. At the same time, in future, you can receive the benefit from that. So then coming to another one is life insurance policies. So this life insurance policies will cover the risk as well as a future you can generate the returns. So in terms of currently you are sacrificing as premiums, in future you can receive the lump sum amount from the insurance policies. So there are multiple types of insurance policies are available. Again here investor have to look over into their objectives of investment and accordingly choose the proper and appropriate life insurance policies for their investment choice. Then coming to another important one is real estate. Here, so real estate means definitely everyone know it's a biggest source of getting returns and capital appreciation. We can enjoy everything can be identified from real estate. Here, as investor having huge funds, then they can contribute into purchasing of lands, right? So real estate keeps the high returns over the years by comparatively equity shares. So that much of returns you can enjoy from the real estate. So but it demands the huge funds. That is only the criteria behind for real estate. So then coming to another important objective, another important investment avenue is precious objects. This precious objects represents about gold, silver, platinum. So if you contribute investment on gold, platinum, likewise means, then definitely that will helpful for your growth feature. So, for example, over the 2 years, how the gold rate increased day by day, you can observe, right? So, it's currently having a huge 10 grams having around a 70,000 plus value. So, that means how the gold rates are increasing continuously, then that is also you can make it as into a one of the investment option. So here not only you can possible to invest in you can purchase in terms of ornaments only, you can possible to invest in terms of getting some units like that. So grams likewise you can add on from the purchasing through your demat also you can purchase the gold. Then coming to another important one is money market investments. Here, whoever the investors may not have enough time to invest their funds, so they have to contribute for short span. Afterwards, they require those funds means then they can choose the money market investments. So this money market investments will give the short span, that means only 1 year. For the sake of 1 year span, you can possible to invest into money market instruments like zero coupon bonds as well as commercial papers, commercial deposits, so treasury bills, like that many ways you can possible to invest in terms of money market instruments. So then it provides returns in terms of interest or differentiation in prices, buying price and redemptional prices. So likewise, difference you can consider as return from the money market instruments. So this is purely opted for short-term investors only. Then finally, another important one is financial derivatives. So this financial derivatives will helpful for the investors in terms of investing into derivative market. So the derivative market derivative market uses the underlying assets, so which traded with the underlying asset only. So this underlying asset should possess the value in values. So those price, based on those prices, how to choose the different types of derivatives like options, futures, forwards, swaps, like that. So according to the requirement of the investor, whether they would like to invest into forward contracts, options, or future contracts, or else swaps, so in what manner they would like to diversify their investment. So who does not have full fledged knowledge on derivatives may not give that much of beneficial fun for them, because have to manage in appropriate manner, then only you can enjoy the huge returns from the derivative market. So this is a very good source for the investment for the who have sound knowledge on derivative market, right? So any objective, these are the investment avenues which are protected under regulatory authority. So whatever the investment avenue you would like to choose for your investment in your career, in that situation try to identify your own objectives, and accordingly you have to choose the appropriate investment avenues for your investment. Thank you.